So, you're thinking about investing in the Kenyan stock market, but you're not quite sure where to start. It can definitely seem complicated from the outside, but you know what? It doesn't have to be. In the next few minutes, we're going to break down exactly how you can get started. Let's get right into it. Right now, there is so much buzz in the air. You've probably heard the talk about the Kenya pipeline IPO, or the government may be reevaluating its stake in Safaricom. Look, these aren't just news headlines. They are huge market events. And they're a massive signal that now, right now, is the perfect time for us to really get a handle on how this all works. But yeah, where do you even begin? The stock market can feel complex, maybe even a little intimidating. The whole point of this isn't just to talk about it, but to give you a clear step-by-step roadmap so you can actually navigate it with some real confidence. So let's start with the most basic question of all. What does investing in stocks actually mean? I promise it's way simpler than you might think. Okay, so think of the Nairobi Securities Exchange, the NSE, as just a big marketplace. But instead of selling fruits and vegetables, people are buying and selling tiny pieces of ownership in Kenya's biggest companies. When you buy a share, you literally become a part owner of that business. Pretty cool, right? All right, so you're ready to jump in. What do you actually need to get started? Well, the good news is the barrier to entry is probably a lot lower than you're imagining. Let's break down your starter kit. Here they are, the 6 essentials. Some of these are obvious, right? Like your ID and a bank account. But the 2 most important pieces of the puzzle are your licensed stockbroker, who is basically your guide to the market, and something called a CDS account. The easiest way to think of a CDS account is like a digital wallet where your shares are held, all safe and sound in your name. And what about that starting capital? How much money do you actually need? Well, while there's no legal minimum, most brokers have a practical starting point. And you can often get started with as little as 1,000, maybe up to 5,000 shillings. So yeah, the barrier to entry is way lower than most people think. Okay, your accounts are set up, you've got some capital ready to go. Now for the really exciting part, making your very first trade. Let's walk through exactly how that happens. The whole process really just boils down to this. You open and fund an account, and then you tell your broker what you want to buy. They handle all the technical stuff on the NSE, and usually within about 3 business days, boom, you're officially a shareholder. Your main job is simply deciding what to buy. So now that we know how to buy, we need to talk about the really big question. Why are you buying? What's your actual goal here? Broadly speaking, there are 2 main ways to make money in the market. Before you invest even a single shilling, you need to ask yourself, what is my goal? Are you investing for a steady stream of income, like right now? Or are you trying to build some serious wealth for the future? Your answer to that question is the key to your entire strategy. If income is what you're after, you'll want to look for dividend stocks. The best way to think about it is like being a landlord. You own a piece of the company, and in return, it pays you rent out of its profits. These are usually the big, stable, established companies, which makes this a really popular strategy for people who want consistent cash flow. On the other hand, if your goal is long-term wealth, then you're hunting for capital gains. This is the profit you make when a company grows and its share price goes up. You buy a share at, say, 10 shillings, and over a few years, it grows to 18 shillings. That 8 shilling difference, that's your capital gain. That's the wealth building part. And this little table just illustrates the difference perfectly. For dividends, you're asking, does this company have a long history of paying out cash? But for growth, you're asking, is this company's business actually expanding and getting bigger? Each goal has its own questions, its own metrics, and is really suited for different types of investors. Of course, whether you're investing for dividends or for growth, no investment is ever a sure thing. Understanding risk, and more importantly, how to manage it, is really what separates smart investing from just gambling. So let's talk about what that looks like. Okay, at the lower risk end of the spectrum, you've got what we call the blue chips. These are the absolute giants of the market. Think Safaricom, KCB, EABL. Their stability comes from the fact that they dominate their markets and, well, people use their services every single day. That makes their earnings way more predictable. Now, moving up the risk ladder a bit, you have solid mid-tier companies. These might be in sectors like manufacturing or construction, businesses whose fortunes are tied directly to the health of the wider economy. When the country's doing well, they do great. But when things slow down, they feel it a lot more. And finally, you have your higher risk investments. This is where you find brand new companies listing through an IPO, or maybe businesses in really unpredictable sectors. Now, it is crucial to understand that high risk doesn't automatically mean bad investment. Not at all. It just means there's a much wider range of possible outcomes, and that demands much deeper research from you. So how do you manage all these risks? You do it by following 4 golden rules. First, only invest money you can truly afford to lose. Never, ever touch your emergency fund for this. Second, diversify. Don't put all your eggs in one basket. Third, avoid borrowing money to invest. And finally, think long-term. Patience is your greatest weapon in this game. Okay, let's circle back to what got us started in the first place. Those big, exciting initial public offerings, or IPOs. They get a ton of hype, but they also fall squarely into that higher risk category. So how should you approach them? When a big IPO comes along, please don't just follow the hype. You have to dig into the official document. It's called a prospectus, and ask the tough questions. Is this price actually fair? Is the money being raised to grow the company, or is it just to let the early owners cash out? And especially for state-linked companies, you absolutely have to consider the political risks. This is your homework.
You know, there's that famous saying, the best time to start investing was years ago. The second best time is now. It's not about regret, it's about taking informed, prepared action today. If you understand what you're buying, if you know your own goals, and you only invest what you can afford, you are already on the right track.
So after all of this, the final question really is for you. Whether it's opening that CDS account, or maybe just researching a company that you really admire, or even just starting to save up that initial capital, what will your first step be on your investment journey?